In the archives of the Bank of England, there is a subscription ledger dated March 1720. It does not record ships. It does not record cargo. It does not record colonial territories. It records names. Lords, generals, royal physicians, the king's own mistress. Next to each name, a number, a sum paid in cash, or an IOU, or a mortgage on a landed estate. They were not buying land. They were buying a promise that within 6 months, their investment would double. It was called the South Sea Company. By August of that same year, those promises would evaporate. Fortunes spanning generations would vanish in a matter of weeks. A prime minister would be expelled from parliament. A royal treasurer would flee to France. A scientist would lose a lifetime of savings, and the British financial system would nearly collapse under the weight of its own paper. This is not a story about speculation. It is a story about architecture, about how a private corporation, backed by Parliament, engineered a mechanism that turned national debt into private wealth, and about the exact moment the ledger stopped balancing. To understand how a trading company became a financial weapon, you must look at the balance sheet of 1710 Britain. The War of the Spanish Succession had drained the treasury. The national debt stood at £9 million, a staggering sum for the era. Interest payments alone consumed half of annual tax revenue. The government was trapped. It could not raise taxes further without triggering civil unrest. It could not default without destroying its credit across Europe. So the Treasury looked for a financial innovation. Enter Robert Harley, the Chancellor of the Exchequer. In 1711, he chartered the South Sea Company. On paper, it held an exclusive monopoly on trade with Spanish America. In reality, that trade was structurally impossible. Spain controlled the ports. The Treaty of Utrecht granted Britain only the asiento, a limited right to supply enslaved Africans to Spanish colonies, and one annual merchant ship. But the company's real function was never trade. It was debt management. The company offered to buy up short-term government bonds at a discount. In exchange, the government paid the company a fixed annual interest rate of 6%. The company would then convert those bonds into its own shares. Holders of government debt became shareholders. The state's liability transformed into private equity. It worked, temporarily. The debt burden lightened. The stock stabilized. But the mechanism had a structural flaw. It required confidence. And confidence, once monetized, demands constant expansion. By 1719, the French provided a blueprint. John Law's Mississippi Company had just absorbed the French national debt, driving its stock price to unprecedented heights. The South Sea Company's directors watched closely. They realized something the Treasury had missed. Debt could be converted into equity, and equity could be sold to the public. The machine was ready. It just needed a trigger. In January 1720, the directors submitted a proposal. They would absorb £31 million of remaining government debt. In return, the Treasury would pay them a 5% annuity. But the real innovation was not the absorption, it was the conversion rate. The company would issue new shares to bondholders, not all at once, in installments. A bondholder could surrender £100 of government stock and receive only £2 in company shares up front. The remaining £80 would be paid in 5 quarterly installments. This was financial leverage before the term existed. It lowered the barrier to entry. It flooded the market with buyers who did not need the full capital. The stock price, which had hovered around £100 in early 1720, began to climb. £150, £200, £300. But the company needed political cover. Parliament had to approve the scheme. So the directors opened their ledgers to members of Parliament. They offered shares at preferential prices. They provided loans that never required repayment. The Chancellor of the Exchequer, John Aislabie, accepted. Postmasters, clerks, even royal household staff received allocations. The bill passed in April 1720. The conversion opened. The public rushed in. Mechanics, merchants, widows, nobles. They mortgaged homes. They liquidated estates. They bought shares not with cash, but with future earnings. The company printed new certificates. They did not represent ships. They did not represent trade. They represented a claim on a debt payment that had already been collected. The directors understood liquidity. They announced a 10% dividend. They bought back shares to stabilize the price. But they were buying with printed paper. The market detached from mechanics. It was now running on narrative. The line only goes up. Someone else will always pay more. By June, the stock reached £400. By July, £600. Brokers issued margin calls. Taverns became trading floors. Subscription lists circulated through coffee houses. The company's directors began selling quietly. They knew the installments could not be sustained. The company's cash reserves were being drained to pay dividends from capital, not profit. The architecture was complete, and it was already cracking. The peak arrived in late June 1720. The stock hit £1,050, but beneath the surface, the conversion mechanism was fracturing. The Bank of England, initially a silent partner, withdrew its backing. The Royal Exchange Assurance and London Assurance Companies lobbied Parliament to restrict new joint stock ventures, fearing capital flight from established markets. The directors, sensing the turn, tried to stabilize the price. They announced a new dividend. They promised another conversion, but they were buying with printed paper. By August, the first major installment came due. Buyers had to pay cash. They did not have it. Sellers flooded the market. The price dropped to £900, then £700. The psychological inversion was instant. The belief in perpetual growth was replaced by the certainty of ruin. Credit froze. Brokers refused to accept share certificates as collateral. The paper wealth vanished. By September, the stock stood at £150. The panic was not confined to London. It spread to Amsterdam, Paris, and the provinces. Banks failed. Estates were seized. Credit networks collapsed. Isaac Newton, who had invested early and sold at a profit, re-entered late. He lost £20,000, a fortune. He reportedly said, "I can calculate the motions of the heavenly bodies, but not the madness of men." The government scrambled to contain the fallout. The Chancellor of the Exchequer was expelled from Parliament. The directors were summoned before a parliamentary committee. Their assets were frozen. Some fled. Others were imprisoned. The state had to choose: let the financial system collapse or intervene. It chose intervention, not with a bailout, with a restructuring. The company was not dissolved. It was dismantled from within. Directors were stripped of 2 million points in assets. The remaining shares were distributed to creditors. The national debt was partially absorbed by the Bank of England. The machine was broken, but the ledger remained open. The South Sea bubble did not end the British Empire. It reshaped its financial DNA. In 1720, Parliament passed the Bubble Act. It restricted the formation of new joint stock companies without a royal charter. It effectively froze corporate innovation for over a century. The trauma of 1720 made Britain deeply skeptical of equity markets. Capital flowed into land, into government bonds, into infrastructure. It built a conservative financial culture that lasted until the Victorian era. But the deeper lesson was structural. The crash was not caused by irrational peasants or uninformed gamblers. It was engineered by a sophisticated mechanism: debt conversion, installment leverage, political capture, dividend distribution from principal rather than profit. It was a liquidity crisis disguised as a wealth event. When we look back at 1720, we see a mirror: the dot-com surge, the housing collapse, the crypto cycles. The language changes, the architecture does not. Convert debt into equity, lower the entry barrier, secure political cover, distribute paper value, wait for the installments to come due. The human variable remains constant. We trust the crowd. We mistake liquidity for value. We believe the line only goes up. In the National Archives, the South Sea ledgers are still preserved. The ink is faded, the signatures are dry, but the mechanics are perfectly legible. They remind us that markets are not mathematical, they are psychological. They are built on trust, on narrative, on the quiet agreement that paper represents something real, until it doesn't. If this story made you think, subscribe, because next week we're going deeper into the economic catastrophes that shaped the modern world. The ledger is still open.